The global trade landscape shifted dramatically in April 2025. The United States, under then-President Trump, imposed new tariffs on goods from the European Union. These tariffs, a form of economic protectionism, aimed to reduce the US trade deficit and bolster domestic industries. However, the move sparked fears of a trade war with Europe. The tariffs target a wide range of European products, from agricultural goods to manufactured items. One sector hit particularly hard is the automotive industry, facing a hefty 25% tariff on cars and parts exported to the US. These new tariffs come on top of existing ones, creating a complex web of trade barriers. Experts calculate the actual tariff burden on EU goods to be close to 39% when using the US calculation formula. This starkly contrasts with the EU's average tariff of 2.7% on US imports. The situation has created significant uncertainty in the global market. Businesses are grappling with disrupted supply chains, fluctuating prices, and reduced access to key markets. The ramifications of this trade war extend far beyond simple import and export numbers. Central European economies, heavily reliant on exports to the US, find themselves particularly vulnerable in this trade war. Countries like Czechia, Slovakia, and Hungary, with their robust automotive industries, are bracing for impact. These nations serve as vital manufacturing hubs for major international car companies. The new tariffs threaten to disrupt their supply chains, increase production costs, and potentially lead to job losses. Czechia, for instance, relies heavily on its automotive sector, which employs over 500,000 people. The tariffs are expected to squeeze subcontractors, reduce profitability for manufacturers, and limit future investments in the industry. Slovakia, with over 73% of its US exports comprising cars and car parts, faces similar challenges. The presence of major car manufacturing plants in Slovakia amplifies the potential economic fallout. Even Poland, less directly reliant on car manufacturing, will feel the ripple effects. The tariffs' impact on Germany, a crucial trading partner, will indirectly affect the Polish economy, particularly its car part exports. Germany, Europe's economic powerhouse, is not immune to the fallout of this trade war. As the largest economy in the EU, Germany's fate is closely intertwined with the overall health of the European market. Experts predict that the tariffs could shave off 0.6% of Germany's GDP, a significant blow to a nation accustomed to steady economic growth. The German automotive industry, a symbol of the nation's manufacturing prowess, is particularly exposed. A 10% tariff on cars alone could impact 0.9% of total EU exports, highlighting the sector's vulnerability. Leading German economic institutes paint a grim picture. The IW Institute anticipates a 1.5% decline in German GDP over the next 2 to 3 years. Meanwhile, the IFO Institute estimates potential economic damages reaching a staggering €33 billion. These figures underscore the potential for widespread economic pain in Germany. The impact of the US tariffs extends far beyond Central Europe and Germany. Other European economies like Italy and Switzerland are also likely to suffer from reduced trade and economic uncertainty. The tariffs are already contributing to higher prices for European goods in the US market, potentially impacting demand and hurting European businesses. Financial markets have reacted nervously to the escalating trade tensions. Global equity markets experienced a downturn, with European equities hit particularly hard. Investors are pulling back from riskier assets, fearing a protracted trade war could destabilize the global economy. Bond yields have also fallen as investors seek safer havens for their capital. The trade war's impact is not limited to financial markets. It has fueled uncertainty, making businesses hesitant to invest and expand. This hesitancy could further dampen economic growth in Europe. In response to the US tariffs, Europe is exploring retaliatory measures. These include potential restrictions on service trade with the US, hitting back at a sector where the US enjoys a trade surplus. Additionally, the EU is actively seeking new trade deals with partners around the world, aiming to diversify its economic relationships and reduce its reliance on the US market.